Vaishna, thank you very much for that. To discuss this company, we're now joined by Akash Sethia, the Head of Strategy at Elin Electronics. Akash, morning. Rima here. This is a highly competitive market, right? Can you tell us about the competitive dynamics? What would be your market share? And if it's competitive, is there scope for you to increase your margin? And also talk a little bit more about the client concentration risk, because that's been highlighted by a couple of people in the market as a risk for your company.
Sure. Good morning. Thank you for having me on the show. So to your first point on our market share, we operate across three key business segments. In the LED lighting segment, we approximately have a 7 to 7.5% market share. In the small appliances business, our market share is approximately 11%. And in the fractional horsepower motor segment, we are market leaders with a market share of approximately 12%. Just in terms of our EBITDA margins, we've historically always been in a 7.5%, 8% kind of band, which are industry-leading margins. The biggest reason for that is the backward integrated nature of our operations. We end up producing most of the sub-assemblies and the components required to manufacture the end product in-house ourselves. Which enables us to invariably be amongst the most competitive players in terms of cost, and also enables us to have a higher degree of control over the supply chain and therefore product quality and timelines. Just to your other question on the revenue concentration risk, we worked on bringing that down. We are cognizant of that fact. About 2 years back, probably the top 5 customers contributed to about 75% of revenues. As things stand today, that number is probably down to closer to between 60 and 65%. And our endeavor and focus is to further bring it down over the course of the next few years to close to 50%.
All right. Hi, Akash. Good morning. Akash, I'm reading the money that's going to come to the company will be used for debt repayment and for some capex as well. So two-part question there. One, what does the debt come down to post this repayment, or are you going to be repaying everything of it? Point number one. Point number two is, what is the asset turn in your business? Since you're going to be utilizing around 35-40 crores for capex, what is the asset turn? And at peak, with the current investment, with the current gross prop, what kind of revenues can you do? I'm not asking you for a guidance. I'm asking you your capacity. Go ahead.
Sure. So just in terms of your first question on the debt, the total debt on the books of the company is approximately 100 crore rupees. Post the IPO, we expect to be completely debt-free. So that's point number one. Point number two on capex, while we intend to use out of the fresh issue of 175 crores, approximately 40 crores towards capex, it is just pertinent to point out that over the past 3 or 3.5 years, we've already done a fairly large capex of approximately 125 crores. So going forward, we don't expect a material capex to come in. As things stand today, our asset turns are probably, closer to 4x on a gross basis, which, in some sense, the business is at an inflection point where, capex has been done. Revenues will come in the year ahead. On probably a steady state basis, we expect our asset turns on a gross basis to be approximately 5 times.
Akash, just to probe you a little bit, last year you did around 1,100 crores of revenues. As you just took us through, 40 crores plus 125 crores has already been put in. So at
Correct.
Peak, what kind of revenues can you do? Keeping in mind that last year you did close to 1,100 crores. What is the revenue potential of the company?
This would be in the range of 1,800 to 2,000 with the completed capex.
Akash, hi. Just tell us what sort of your customer base are they exclusive to you? The largest customer for you, is it exclusive, or they work with other players as well in the EMS space? I'm just trying to understand what is the competitive advantage you have, because in this business, if you're a large company, OEM, sort of on the lighting side or whatever, and a company on the other side offers large scale. Your peers are very much larger, right? Amber, Dixon, etc. What's the offering, compelling offering, or the competitive advantage you will have going forward?
Sure. So, the way we view ourselves, like I mentioned at the outset, is that we end up being, look, philosophically, a customer looks at three things in our view, right? Cost, quality, and delivery. Because of the backward integrated nature of our operations for the product segments that we operate in, we typically end up being the lowest cost manufacturers because as opposed to a mere assembly player, we end up producing most of the components and the sub-assemblies required in-house ourselves. So therefore, we end up, being one of the lowest cost players. Just in terms of quality, because we are doing everything ourselves, we have a much higher degree of control on the quality of the product, as also on delivery timeline. So in our mind, if you get the cost, quality, and delivery right, it's a one-stop shop solution for most customers, and therefore it's a winning combination. So that to our mind is the biggest competitive advantage that we provide our customers. To your question specifically, there is no one-on-one relationship. Customers obviously source from us as well as other players as well.
Just last point, that 1,800 crores that you mentioned,
Sure.
do you have visibility on when you will be able to do that number?
I think there are SEBI restrictions on talking about specific timelines. So I am unable to give you a specific time, but in general, we expect to do that over the course of the next 2 to 3 years.
Okay, all right, Akash. When you list, then we'll have some more questions for you, and at that point of time, you could give us numbers. SEBI as well will, you'll be able to go according to the rules out there. But all the best, and we look forward to chatting up with you on listing date. Well, let's move on then. Deepak Fertilizers, that's the next corporate on our radar. We're speaking to the company post the announcement of a demerger of its mining chemicals as well as fertilizer business.